When you are wealthy, it is a really, really good way to multiply that wealth in a very tax efficient manner. But if you don't have very much money, it's really hard to make that happen. The most common inquiry I get, the most common question that I get is, hey, Nick, I've got X amount of cash. I want to buy a storage facility worth this much money. How do you recommend me going about this? And let me start out by saying what I'm about to tell you, there's a lot of nuance. I know folks who got started a different way. And also where I am in my career is different. But I'm just going to tell you about this situation because it's the question that I commonly get, and it might actually be the situation that you're in right now. Guy reached out and said, hey, Nick, I want to buy this storage deal. It's $1.5 million. I got about $150,000 to put down. I want to do an SBA loan for 85 or 90% of the purchase price. And I want to move forward and buy this property. My question, I always follow this up with a question. And it sounds really ridiculous, but you'll figure out why I ask this. I always respond, how much cash do you have? Liquid net worth or near liquid net worth, meaning your cash in the bank and your equities, your public equities that you can sell, not your retirement account, not your home. I'm talking cash or near cash. That's liquidity. How much of it do you have? Number two, are you from a wealthy family? And number three, do you have wealthy friends who would invest in your deal and help you capitalize this deal if you were to raise money from other people? Or do you know wealthy people who you could potentially sell on an investment? And what I mean by the family question is, frankly, in commercial real estate, and you're looking at a $1.5 million property, can your dad or mom, can your parents stroke you a $1 million check to bail you out of a sticky situation if they had to? So if the answer is no to any of these questions, or all of these questions, with $125,000 or $150,000 of liquidity, you don't have enough cash to get in the self-storage business. You have no business buying a $1 to $1.5 million property if you only have $150,000 in the bank. That's how you go broke. And my advice is forget the real estate and focus on making money somewhere else. Now, look, there's a ton of nuance around this. My mentor, Chris Powers, got started in 2010 in the peak of the great financial crisis, and he was buying houses. It was actually before that. He was buying houses for virtually nothing. He was putting almost none of his own money down. He was fixing them up. He was adding bedrooms. And that's how he got his start. And look at him now. Owns over $1 billion worth of industrial real estate. There are many ways to do this. And yes, an SBA loan can work. And yes, if I were giving myself advice, now this is a really important part. If I were giving myself advice back in 2013, when we were starting the process of our self-storage facility, actually 2015 is when we really, bought the property and got started. If I were giving myself advice, I probably would have advised myself not to do it. And that's going to sound so ridiculous because that's a deal that we built a self-storage facility, bought the one out across the street. Our all-in basis was $2.9 million. It's worth over $8 million now. It's personally put over $1 million in my checking account, and our investors have made a killing on that deal. But what you got to realize is that I'm at a different phase in my career now. I've had some success. My net worth has grown. We have a lot to lose, and I feel totally different about risk. So everything you read about from me when you listen on this podcast, understand that, hey, Nick is coming at me and giving me advice from the perspective of somebody who has made some money and is now worried about not losing that money. I spend all day, every day thinking about risk, thinking about how to manage the downside on properties, and thinking about how, hey, if an investor is going to give us cash and we're going to raise a certain amount of money on a certain deal, how can I make sure that I'm not going to lose that money? That's a totally different perspective than somebody with a little bit of money, nothing really to lose, and trying to go and grow. Now, if you have wealthy people around you, I recommend you go back and listen to the episode on this podcast, or if you're watching this on YouTube or Twitter, go back and search, the Nick Huber Show, Real Estate Private Equity. I have an episode on this exact podcast. I'll link it in the show notes that literally outlines how to raise money with other people, raise money from other people. But if you're gonna, let's just simplify this whole process. You have a $1 million self-storage facility. How much cash do you need? I would personally syndicate a deal if I have wealthy people around me. Maybe I only have 100 grand or 150 grand of my own money, but yes, I do have wealthy people around me that invest in this money, or my parents could potentially bail me out if something's going to go wrong, friends and family. I would syndicate the deal. You got a $1 million purchase price. I'm going to capitalize 1.2 million, which means this is another common mistake in the real estate business. So I'm going to go buy this property and I'm going to have absolutely no cash inked in and listed for closing costs, the attorneys, the title insurance, the cost segregation, operating capital, meaning the money you got to put in the bank to start running a business, to pay bills before you get paid. You have CapEx, capital reserves, meaning you got to replace a sign. You got to have money set aside for if a driveway washes out. You're going to have to replace a roof at some point. You got to build a fence. You got to have cash to fix problems in real estate. And they can be very, very expensive problems, as many of you know. Another part is just the capital reserve, the cash reserves, a contingency on hand in case things go wrong. On the average $1 million deal that we're buying, we're capitalizing it at 1.2 million, meaning about 30 grand in closing costs, another 50 grand in operating capital, and 120 or so in capital expenses and capital reserves. So I would syndicate the deal. I had $1 million purchase price. I'm capitalizing 1.2 million. I'm going to get a $500,000 to $600,000 loan, which you might say, Nick, that's only a 50% loan. Well, debt is really expensive right now. It's really hard to find pieces of real estate that will cash flow if you borrow a lot of money. You have negative leverage. You can search negative leverage on Google if you don't know what that means. But it basically means that every dollar you borrow costs more to borrow that money than yield you're getting from a property. Properties are still trading at 5 or 6 caps, maybe 7 caps in self-storage. And your debt constant, how much you're spending on your debt every single day or every single year, is 7-8%, because it's a 6.5% interest rate plus you have principal on there. So if you borrow $1 million, you're paying $75,000-$80,000 a year to borrow that money. And you're not buying an 8 cap. You're not buying something that can generate that kind of cash. So every dollar you borrow is going to reduce your cash on cash returns. That's called negative leverage. So that's why we use less leverage. And then after I do that, I would operate it for upside. I would operate it for a fee, charge a fee, and then I would get a chunk of the promote. I'd put maybe 20 or 50 grand of my cash into the deal, depending if I had $100,000 or $150,000, and I would buy the property that way. So I see several problems happen here that rookies make. Number one, I think too many people make the mistake of putting too much of their own cash into a deal and keeping nothing in reserves. That means they buy $1 million piece of property, they have $150,000 total cash to their name, and they put all $150,000 into this deal. Then before closing, a surprise comes up, or after closing, a surprise comes up, and they're totally out of money. The number one rule in real estate is do not run out of cash. I'm going to say that again. The number one rule in real estate is do not run out of cash. If you run out of cash, it's game over. If your loan matures and you don't have cash, it's game over. If a big capital expense shows up and you don't have any cash and you can't borrow any more cash from the bank, you need a new roof, plumbing, utilities, whatever, game over. Every single bankruptcy in real estate has happened for one reason, and it's because that real estate investor ran out of cash. They didn't have any more cash. So never tie it up. Keep a significant reserve. If you have 150 grand to your name, why would you put more than 50 grand into a deal? You need to keep some cash on the side to solve problems, to get yourself out of sticky situations. Second big problem I see is too much leverage. They're buying a property right now, which we could be heading into a recession. I don't think it'll be as bad as what I thought it might be 6 months ago, but we're heading into a recession. Interest rates are going up. Values are dropping. Right now, values are dropping, and they're borrowing 80 to 90% of the price of a property. They have a lot of debt on it, so there's not a lot of margin for error. If they're operationally, they're not the best. If revenue drops, if cash flow drops, or if they just aren't able to increase it, boom, they owe more money than the property's worth, and they're underwater and they're bankrupt. So to buy, another big problem that I just explained is not accounting for the cost of doing business in real estate. Buying and selling real estate is really expensive. To buy $1 million property, you're going to spend 30 grand in closing costs. You got insurance, you got attorney fees, you got surveys, you got appraisals, you have phase 1 environmentals, potentially phase 2 environmentals. You got title insurance. You got a cost segregation study. You got to fund an account. Then you got to fix up all the broken stuff. Then you got to have some cash in the bank just to solve some problems if things happen. Going back and asking your investors for more money is horrible. It sucks, and you should never do it. And if you tie up all your cash and you need this extra money, you're just in trouble. This happens to people all the time just because they don't think about the cost to transact real estate. So you hear a saying, real estate investors are cash poor and asset rich. Meaning, hey, they got a lot of assets, they got a lot of net worth. Maybe they got a $10 or $20 million net worth because they own all these properties, but they have very little cash. Real estate investors have very little cash, and they're, a lot of assets. And to some degree, that's true. I'd say, me personally, my net worth is 75 to 80% tied up in my real estate holdings. It's not liquid. It's not cash. But I still have quite a bit of cash. I keep several $1 million personally on hand to get myself out of sticky situations, to have as reserves. And every single building we buy, we're raising an extra $200,000, $100,000, $300,000, $500,000 in cash reserves, keeping them in the bank across our entire portfolio. All 63 properties, 1.8 million square feet, plus me and my partner's liquidity on hand, we have over $10 million of cash or quickly accessible liquidity that we can use to solve problems. And that is our insurance policy. Something comes up, it's not stressful. One of our loans matures, it's not stressful. Those are the things that let us sleep at night. I can bail out a property if it's struggling. If an investor becomes a big pain in my butt and they wrote me a check for $1 million, I can get them out of the deal. I can write them a check to get them out so that I'm not worried about that problem anymore. And most importantly, with this cash on hand, is that we can pounce on new opportunities. If we find really, really good deals, we can put some of our cash into those deals, and we can get bank loans. The banks like to see our cash on hand, the lenders, so that we can have a better, more advantageous situation when it comes to borrowing money from a bank compared to other, illiquid investors that bankers are looking at. So you might be thinking, Nick, I'm listening to you, but I don't have millions of dollars sitting around. What do I do? Now, here comes the cold, hard truth of what you might not like to hear. Well, before I get there, if you have access to cash, you're from a wealthy family, you have people that you know that have money that would trust you to buy a piece of property and you can raise it, by all means, real estate is ready for you. You can make it happen if you're resourceful. But for most people, we don't have a lot of friends. When I started, I didn't have a lot of friends who had a lot of cash. My family wasn't necessarily super wealthy. And I was able to get in the real estate game because I started a small business that spit out $300,000 to $500,000 a year for several years in a row. So you might say, Nick, I'm listening. I don't have the money, but what do? I only have a couple $100,000. I want to get into real estate. And there's a couple options. Okay, maybe commercial real estate is not for you, but maybe you can buy a house or a rental property or a really small self-storage facility, $200,000 or $300,000 self-storage facility. Maybe you can do all of it on a smaller scale, but commercial real estate generally is very tough. You have to be well capitalized to play the game of commercial real estate. So for most people, 90% of the people listening to this podcast right now, you need to forget about real estate. Go do something else. Okay, yeah, educate yourself. Continue to listen, continue to study, continue to look at the world around you to spot opportunities and potentially buy a piece of real estate, but focus on making some money somewhere else. If you look at most real estate investors, I'm saying 80% that have ultra high net worths. I'm talking $10 million and up. 8 out of 10 of them started with small business, with entrepreneurship. They started a company. Francis Greenberger, I got his book right here behind me on this bookshelf. He has a book called Risk Game. I highly recommend it. It talks about his life in New York City and how he came to own hundreds of millions of dollars worth of real estate in the 70s and 80s in New York City. His family owned a business. He took over that business. He made a ton of money in that family business and boom, put it into real estate. Many other investors are in the exact same situation because real estate, unfortunately, the big lesson here is that real estate is a really, really good way to grow wealth. When you are wealthy, it is a really, really good way to multiply that wealth in a very tax efficient manner. But if you don't have very much money, it's really hard to make that happen. And in my opinion, in my humble opinion, real estate is not the way to create wealth from scratch. So if you're following all these folks on social media, they're talking about SBA loans, they're talking about wholesaling, they're talking about doing all this stuff with no money down. It's a sexy thing and a lot of people click on it and all that stuff sounds great. But in my opinion, it's all bullshit. Those are pipe dreams. You'll just read and study that shit for years and years and you'll end up never being in the business. I recommend stepping away from your computer, stepping away from those influencers, and focusing on making some cash. Turn on the Sweaty Startup podcast. It's one that I have that I talk all about management, business, and entrepreneurship and making money. My advice for most people would be forget it. Forget real estate. Go make some money. Now, it sucks to hear this. I know. And it's not sexy for me to say this. How much money do you actually need on hand? I'd say to go out in the commercial real estate business and buy a piece of property on your own, you need to have at least access to $500,000 of liquidity. And that's to buy $500,000, $750,000, $1 million property. But if you know something, and there's nuance here. If you know how to do something, if you're confident in your operation ability, if you think you can go find a really good deal that's worth $2 million and all you got to do is raise the rents and rent units and run the business and you're really good as an entrepreneur. Look, real estate is entrepreneurship. It is small business. Everybody thinks real estate's passive. Hey, I'm going to buy this property and just get mailbox money. That's not how it is. There's so much overlap between small business and entrepreneurship. So, go focus on making some cash. If you got $400,000 or $500,000 that you can put to work, real estate's for you. Or if you got some people that can invest and partner with, real estate's for you. But for the most part, focus on making some cash.
Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.